Hello, welcome to session 3 of our basic training. We started with what trading is. We talked about what is tradable. We looked at the assets that are being traded when it comes to the global financial market. We also considered who the traders are, who are the participants, who are the influencers. We also talked briefly on when and how to trade. Session 2, we looked at trading terminologies, trying to understand some special terms that relate to trading and what they mean. Today, we'll be looking at introduction to fundamental analysis. Mind you, this is a basic class. We have deeper trainings, more advanced trainings on fundamental analysis and some of the other topics we talked about. But for now, we'll be looking at introduction to fundamental analysis. Let's talk about it. Yes, so when we talk about fundamental analysis, first of all, I want you to understand that we have 3 forms of analysis, 2 basic ones. The first is fundamental analysis. The second is technical analysis, and then we have sentimental analysis. Remember that it's all about buying or selling. We ask the question, when do you know when to buy? When do you know when to sell, right? Because prices of assets are always going up, going down, but there are factors that influence them. And fundamental analysis seeks to find out the political, economic, and social factors that affect the market. You understand? When you talk about fundamental analysis, you're looking at things outside the chart, outside your MT4 chart, outside your MT5 chart, outside your trading view chart, outside your X-station chart. What are those things happening outside the chart that are affecting the chart, right? And so that's fundamental analysis. When we identify drivers of an economy, when we identify drivers of a currency's economy, what the data that comes out, what it means and all that analysis to determine whether to buy or to sell is referred to as fundamental analysis. So when we talk about fundamental analysis, we have various components. We have the government and politics, the government, policies made by the government, political factors actually affect the market, right? Microeconomics, macroeconomics, environmental conditions, company analysis, all these data, okay, affect the market, create sentiment, affect demand and supply, and all these are components of fundamental analysis, right? And now, when we're talking about analyzing fundamental analysis, we try to buy those currencies. We try to buy currencies of economies that are strong through the data, GDP data, consumer price index data, interest rates data, bank rate data. All these things tell us if the economy is strong or not. For strong economy, you will see the value of their assets go up. But for a weak economy, you see the value of their assets actually fall, right? So we make use of what we call economic calendars, economic indicators to actually tell a strong and a weak economy. Okay, if you're trading the euro against the dollar, for example, if a data comes out that shows that the euro is strong at a particular time, you would see the value of the euro rise. If another data comes out that shows the euro is weak, you see the value of the dollar rise against the euro, because there's always this exchanges back and forth between both pairs, right? Now, when you talk about the weak economy, what are some of the hallmarks of a weak economy? You have marginalized orientation, you have import labor, you have import dependent on imported goods and services, a lot of debt from borrowing money, lower spending because the government is not spending, corporate social responsibility. You see that. But when you see a strong economy, you see that they produce their labor, right? They don't even import labor. They produce their goods and services. They lend money. They spend more. You understand? So these are hallmarks of strong and weak economy, right? I want you to understand that when we refer to fundamental analysis, we are looking at the economy. You understand? We're looking at, for trading the dollar, doing a fundamental analysis, we're looking at the data, recent and future data coming out in the dollar. We're relying on the information from those data to determine if the dollar is strong or weak, to determine if the dollar is in good hands or not. You understand? And some of these data are broadly classified into four or more, actually. We have growth. Under growth, we want to check the gross domestic product, that's the GDP. What is the level of production? Because we believe an economy that is producing very well is a strong economy. An economy that has increase in production is a strong economy. We look at the retail sales. What is the level of demand? The retail sale gives us the level of demand. Look at manufacturing production. Look at durable goods orders. Look at trade balance. Are they exporting more than they are importing, or are they importing more than they are exporting? An economy that exports more is stronger than an economy that imports more. You understand? Then we look at current accounts, right? Then we check central bank, where we would find out their monetary policies, interest rates, what is the level of interest rates they are giving out, which also look at inflation. What is the level of inflation? Prices increasing, consumer prices, how are they increasing? How are producer prices increasing? What are the average hourly earnings? Okay, we'll also check out employment, NFP, earnings, job openings, and all that, right? So when we look at this data help us to determine whether an economy is strong or not. This data help us determine whether an economy is strong or not. And we will only buy assets of a strong economy while we sell assets of a weak economy, right? So when we check this data, it's always important for us to know three things. The first one is, what is the previous data? The last time this data came out, what did it come out as? The second is, what is the forecast? What are we expecting the next data to come out as? And that's when that data is released, we want to now check what the actual report is. So it's the previous report, the forecast report, and the actual report, right? And then when we check this report, we find out what are their effects on currencies, commodities, and indices. Sometimes certain data affect currencies differently from what it affects commodities, right? Because generally in the economy, there is also a trade-off between currency and commodity. Like I explained our first class, I could decide to take, if I think the economy is strong, the currency of an economy is strong, I could decide to invest in the currency. But if I think the currency is weak, I would rather use that currency to buy gold or to, buy stocks. So there's always usually a trade-off. So you need to analyze what the effect of that data is on currency. You analyze it differently on commodity. You analyze it differently on indices, right? And when you do this analysis, you can determine or decide if you want to trade or not. Right now, the question is, let's take an example. Sometime in 2016, right? Sometime in 2016, there was this referendum that was held. There was a referendum that was held in the UK, okay? And the idea was two options: leave or stay, right? I was regarding the European Union. Should we leave the European Union or remain in the European Union, right? So leave won by 51.9% and stay to 48.1%. Now, this is something happening outside the chart. This is a political event. This is a political factor, but it influenced the market so much that the next day, 2016, Thursday, by Friday, 24th of June, 2016, price fell about 1,780 pips against the dollar. So price fell 1,780 pips against the dollar, which is, crazy. For the sake of context, if you're trading this with a standard lot, okay, you would have been able to make, there was a potential of $17,800 to be made that day, but not just because of any technical or whatever, because of the effect of that particular news or that particular event. So you need to watch out for key political events. You need to watch out for election period. You need to watch out for election results. You need to watch out for peace, for conflict. You need to watch out for diplomatic relations between economies, wars, sanctions. All these analyses are fundamental analysis, and they help you to determine what the market is going to do, right? And how to take advantage of the market. Now, The beautiful thing about this is a long time ago where people started trading, a lot of traders were very much interested in technical, and so they spend hours reading the charts, trying to understand bullish and bearish patterns, but paying little attention to what was going on outside the chart. But nowadays, because of where we are when it comes to information communication technology, it's very easy for us to follow up some of this data. So much so that we have what we call economic calendar nowadays. Economic calendar are structured calendars that tell us when and exactly what time some of these high impact political, economic, and social information are coming out, right? So at the click of a button, we can actually see when and prepare, right? You CNN, Bloomberg, Al Jazeera, all these guys help. But we have some very important websites. As you see on the screen, we have forexfactory.com, we have investing.com, we have oilprice.com, we have Reuters, we have MyFX book, right? So for forexfactory.com, you get information regarding Forex. Investing.com also would help you. Oil price will give you prices and data fundamentals regarding oil, regarding natural gas, and all that, right? We're going to quickly look into the first two, forexfactory.com and investing.com. Let us check it out. Okay, so I would share my chart with us where we look at the difference between Forex Factory, investing.com, how we can navigate the website to tell what the market is doing at one point in time, right? So here we go. Now let's begin with forexfactory.com. This is forexfactory.com. This is what the website looks at. Forex, Forex, factory.com, no space, right? It takes you here. It takes you here. At the time of this particular training, this is what it looks like, right? When you come in here, you click on calendar, it takes you to calendar. This is the calendar for this week, okay? And this calendar tells you what data is coming out. The first thing you will notice is that by the left side here, you have date, okay? You have date, you have time, right? You have currency, you have impact, and the likes, right? So what Forex Factory does for you is to show you the date this data is coming out, the time exactly this data will be coming out, the currency that this data affect, the level of impact. That's what it does here, right? So first thing you want to do when you get into Forex Factory, you want to make sure that your time is correct. Make sure that your time is correct. Make sure you're using the appropriate time zone. If your time is not correct, come here, change to the appropriate time zone. If you want AM or PM or you want 24 hours, you do that, and then you select save settings, right? The next thing you're going to want to do is come to filter at the file right here. Come to filter. You can select filter. Now, when you select filter, what you will get is you can decide what type of data you want to see. Do you want to see high impact, which is denoted by the red folder? Do you want to see medium impact, which is denoted by the brown folder? You want to see low impact, which is denoted by the the yellow folder, or non-economic data, which is denoted by the white folder. You can also decide what type of event you want to see. You can decide if you want the data to be shown giving you weekly view or daily view or just tomorrow or all that, and you can decide what currencies you want to. Some persons just put high impact because you advise that high impact is the data you should look out for because they draw the most volatility or the most response in the market. But yeah, also medium impact has been known from time to time to cause volatility in the market, right? I myself just leave everything here because I want to see everything. Now, when you're done, you can apply filter and you have it here. Now, how does this work, right? You have time, which is the exact time that actual data will come out. You have currency, which tells you what currency pair, what particular currency this data would affect. So if I was interested in something like JPY, I will be looking at JPY pairs, right? And then it tells me the impact. The yellow folder, like I said, is low impact. Low impact data doesn't garner much volatility in the market, doesn't garner much response in the market. The brown folder is medium impact, just a mild reaction in the market, but the red folder is high impact. That garners strong reaction in the market, right? You could also come here and see the detail of the data. Once you click on any of these folder, you can see what the data is all about. You can see what it's all about, what the source of the data is, the next time the data is coming out. You can also see the history of the data, the past 5 times data has come out. You can see related stories on the data, just that, to make sure that you are, what's the word now? You're fortified with enough information about that data, right? But most importantly, where the analysis comes up is this 3 here. These 3 here is where we're going to talk about: actual, forecast, and previous. Actual, forecast, and previous. We'll start from previous. Previous gives you information regarding the last time that data came out, what it was like. Forecast is a prediction based on some economic factors, prediction of what the next data will look like. And then actual comes up at the exact time that the data is expected to last. And that is where analysis comes up, because from our analysis, we usually look at the previous, okay, and then we compare the forecast with the actual. We'll compare what we're expecting with the actual. Let's take it like this. Very simple. If I was expecting something, if somebody called me, somebody rang me up and say, Ed, come to my office, I automatically remember the last time I went to a person's office. I remember that, oh, anytime I go to this guy's office, he always gives me at least, at least $500. Oh, immediately I'm happy because I expect, right? Because of what happened previously, I automatically expect at least $500 again, right? So that is the expectation. That's the forecast. Now, when I go to his office, whether he gives me $500 or not, that will not affect my reaction, because now I have an expectation, right? And then it is, oh, I want, at the end of the day, he says, oh, thank you so much for coming. He gives me a hug, gives me a very firm handshake and say, have a nice day. Now, even if my focus was $500, what I actually got was zero, which is much less than what I was expecting. And that creates disappointment. But yet, at the end of the day, he could give me $500 or even $1,000, and I'll be elated because I'm so happy that what I now got finally is equal to or more than what I was expecting. That is how the market works. At the exact time of the news, when the data comes out, we compare it with what we're expecting. If it is equal to or better than what we're expecting, it means that that particular asset, that particular nation's currency will experience a significant boost in value, will rise, will buy. So they say when your actual value is greater than or equal to forecast, it's a buy for that particular currency. What does that mean? It means that if I was trading USD JPY, for example, and the data, a high impact data, these are not high impact data, but let's say a high impact data. Okay, let's do it like this. We have GBP, which we're expecting, right? What the previous data came out as is 135,000 for claimant count change. What is claimant count change? I could select here to read about it. Change in number of people claiming unemployment, right? So that means that if there is a change from 135, we're expecting 95,000. That means we mean that less people are filing for unemployment, which is good. So if this data comes out less than 95,000, that means, oh, more persons have gotten employed. That is a good thing for GBP. So what will happen? I would notice that GBP USD is expected to rise in value. I will buy GBP USD. I'll buy something like GBP JPY. I'll buy something like GBP CAD. Right? But if the data comes out and it's even more than 95,000, which means more persons are filing for unemployment, that means there's an increase in unemployment. I would see a significant fall in the value of GBP. I see a significant fall in the value of GBP. Still on GBP, the last data, the previous data here was 0.0%, right? GDP, which is the number of production, gross domestic product, right? Now, I am expecting an increase from 0.0% to 0.2%. So if the final or actual data, which will come out exactly 7 a.m. at that time, if that actual data comes out higher than 0.2% or even equal to 0.2%, we'll see a significant rise in the value of the Great British Pound against other assets. Right, so that is just the summary of how it is. We compare the actual with the forecast, and we determine comparing the actual with the forecast tells us whether that particular asset is ready to be bought or sold. Right, sometimes also some data that come out are not quantitative, like this one here. By 1:10 p.m., we can see that under the Canadian economy, the Bank of Canada Governor McClellan will be speaking. Now, he's speaking, that's a speech. It's not a quantitative data. There is nothing for us to compare with. So to trade this particular data, we would have to follow the speech of Governor McClellan. See what he's saying. When he begins to talk about strength in the economy, when he begins to give what we call hawkish statement, which hawkish statement that signal an increase in interest rate, you will see strength in the Canadian dollar. But if he's talking and there is no confidence, okay, what he's saying is actually signaling dovish statement, which means a cut in interest rate or a weak Canadian economy, you will see a fall in the economy of Canada. And this is how Forex Factory works. Okay, this is how Forex Factory works. At the time of the data, you compare the forecast with the actual, right? Investing.com is also another website you can work with. Investing.com, INVESTING, investing.com. When you come to investing.com, you can go to their economic calendar here. Economic calendar. Once I select the economic calendar, I will also need to adjust my time setting. Make sure that you're using the GMT that works with you, right? For investing.com economics calendar, we also have time, we have currency, we have impact. Now, instead of folder that Forex Factory uses, investing.com uses stars. 3 stars means a high impact. 2 stars means medium volatility. 1 star means what? Low volatility. And so you can get the event, you can get the actual, the forecast, and the previous. In fact, the beautiful thing about investing.com is that you can create an alert for when that data comes out, right? So it's also about comparing the forecast with the actual. When the actual data comes out and it is better or at least equal to the forecast, there's a strength in that economy. But when the actual data comes out and it is lower than the forecast, there is weakness in that economy, right? So that is just a practical example of how this data work and how we can trace them and how we can track them, right? Now, key notes before placing a trade on your chart. You should be able to accurately read and interpret data reports before you place a trade. Focus on high impact news with red folders for best trade, right? Now, when the actual is greater than the forecast, it may not positively affect the currency if there are other things. For instance, sometimes in countries where they have political conflict, a good data may not necessarily give that economic strength. So there are other things to also consider, right? There are other things to also consider. You need to be sure that that is an economy that is stable to a particular degree, right? Good. Now, trade at the exact moment the news is being released. Most times, volatility do not last long in the market. It's hard with fundamentals to tell how long volatility lasts, right? So the best way to trade it will be to enter within a very short period of time with a very good lot size, come out with as much profit as possible, right? You can use technical analysis knowledge to define and determine your risk reward ratios. I really believe that the best analysis is a perfect combination of fundamental and technical analysis. I do not think that it's very possible to be consistently profitable in this business just focusing on fundamental analysis. The same way I do not think it's possible to just be consistently successful just focusing on technical analysis. Consistent success is a fusion of technical and fundamental analysis, right? Now, once you notice volatility is over, close your trade and move on, please, right? That is very important. That's very important. Now, you could either do a pre-news release, which means you could take a pending position just a few minutes before the data, use your buy stop, use your sell stop. This particular strategy can be very important, especially if you're not very clear on where the market will go, and so you want to take advantage of whether it goes up or goes down. But it could be very risky because if volatility is low, both positions could be taken. So when you're placing your buy stop and sell stop, it's very important that you consider breakout zones. Okay, let your pending order not be too close to the market. Also, because of the fact that the market is moving at such a fast pace, there are all issues of slippage. It's very possible that there are gaps in the market, slippages in the market. You want to be careful with such, and that's kind of the disadvantage with using pending order before the news, right? Then you could do at the news release. That means you could watch Forex Factory or investing.com or any economic calendar you're using at the time of the news release. You see what the data comes out as and place an instant trade in line with the data. That is much better, even if the disadvantage of that is that sometimes immediately the market comes up, immediately the data comes up, the market moves at a very fast pace and it may be hard for you to enter, right? But it helps because now you're trading with more knowledge instead of just buy stop and sell stop, and you're just hoping for market to go in a particular direction. Then the next thing is the post-news release. After 30 minutes, at most an hour, most times price retraces after a news because the news creates a sentiment, creates a jump in the market, but after a while price returns to technical ground. So you could actually wait for the data to come out, and then trade the retracement. You understand? You could trade the retracement. So you could do pre-news release, you could do at the news release, you could also do post-news release, right? That's it. Now, finally, we're going to look at some important data that you can watch out for if you want to trade fundamental. The first one is consumer price index. Consumer price index measures inflation, so it's important. You can check out for consumer price index. Most times when inflation data comes out, when inflation is higher than normal, it depends. Most time when inflation comes out and is higher than normal, it could give that particular economy strength because of the expectation that interest rates will be released. If the inflation report comes out is lower, it could make that economy weak because of the expectation that interest rate will not be considered. Okay, and then we have bank rate, which looks at interest rate. A stronger interest rate, an increase in interest rate will give strength to that economy. A reduction in interest rate will give weakness to that economy. And we're talking about immediate reaction of the market, right? Immediate reaction. Then we have GDP, which is gross domestic product. When GDP increases, it means that an economy's production capacity is increasing, and that's good. Okay, but the opposite would happen if it reduces. We have press statement by bank head and country president. We have PPI, producer index, which is just like consumer price index, but consumer price index considers consumer goods, while producer price index considers producer goods or raw materials, right? We have manufacturing PMI and services PMI. We have non-farm payroll, which happens first Friday of every month. Such a big news that everybody looks forward to. We have crude oil inventory, take stock of the amount of oil in the inventory, right? If there is a lot of oil in the inventory, it means demand is low because inventory is looking at in warehouse or storehouse. If it is high, it means demand is low. That will bring down the price, right? But if it is low, that means demand is high. That will take up the price. We have trade balance, the difference between import and export, employment change, unemployment rate, and many more. Okay, so make sure that you're taking informed decision whenever you go to trade. Before you go into the market and place any trade, you want to make sure you do proper fundamental analysis. What is the current gist in the market with regards to this particular asset? Oh, I want to trade USD JPY. What is the current gist in the market with regard to dollar? What's the current gist in the market with regard to JPY? Compare these, see which one has a better data, and then you can now use your technical analysis to determine where to go into the market, right? Combination of these will help you take better trades and give you consistent profits, right? Of course, we look forward to your feedback. Drop in the comment section what your experience with fundamental trading has been. If you have questions, we would do our best to provide the needed answer. But yes, the next thing we'll look at is introduction to technical analysis. So make sure you join us in session 4 of the basic training. Thank you for your time.